Lee, thank you so much for joining us here at SuperReturn.
Thanks for having me again.
A year ago we spoke here in Berlin, and I think we ended our conversation with me describing you as a well-informed optimist. So are you still feeling that way, and what are you seeing in terms of that volatility effect at the moment?
Yeah, well, a lot's changed in the past 12 months, but honestly, we're very close to the same place that we were last year. Valuations, particularly liquid credit markets, are relatively tight. And also we've seen a massive change in growth estimations as well too. So pre-Liberation Day, as we called it in the US, our best consensus economists that we use were looking for about 2.5% growth. And now growth is just looking for 1% growth right now in the US this fiscal year. You contrast that with where valuations are. So what we'd like to say is that something has to give. Either growth has to rebound and come back, or valuations have to widen out. But to your point, we're able to find things to do in almost any market. So what we're still finding to do are more idiosyncratic opportunities. So less so in the regular way loan and bond markets. Where we're really finding opportunities is more on the idiosyncratic side, in the structured products part of the market, either in mortgages here or in the US or here in Europe actually. We're also finding things to do on opportunistic credit side. A lot of what's being talked about in government in the US is impacting sectors like healthcare. So we're finding some things to do in the opportunistic part of the market on the healthcare side. But to your point, we tend to be optimists. I think most people don't think of credit investors as optimists, but we love volatility. So in these periods of volatility, that's where we're able to find a lot of things to do generally.
So in terms of impact of that volatility, it's kind of just having the finesse and the expertise to seek out those opportunities, as you say.
Yeah, unfortunately, I've been doing this for almost 30 years now. This is honestly one of the most challenging environments because markets are being impacted by tweets on a daily or hourly basis, which we like to think about what things are going to look like in 6 months or 12 months. So it really puts throws things to the side a little bit, but it does create different opportunities than what we've seen historically as well.
Now, a year ago, as I said, we met and we talked then quite a lot about the distress cycle, default rates. Given the conditions we have and what we've just been reflecting on, where are we at in that cycle now in 2025, and what are you seeing there?
Yeah. One thing is we're still not expecting recession. Even at the peak of the volatility during the month of April, again, the best economists that we use thought the odds of recession in the US were maybe 40 or 45%, and that's come down here. So we're about, I think most people say 25 to 30% odds of recession. On the other side of that, and what people have been consistently worried about the last few years has been about interest rates being higher for longer. So particularly in the markets that we look at on the credit side, there's a lot of floating rate debt. With the deficit spending that we're likely to continue to see in the US, even here in Europe, there's talk about consistent spending for either infrastructure or defense. That's keeping rates higher for longer. So ultimately, what you are seeing is default rates are starting to rise, but not anything material from that sense. What we talked about a little bit last year is the construct of liability management. That is continuing to be very persistent. It's multiplied over the last few years. And ultimately what that is restructuring of companies' balance sheets outside of an actual bankruptcy process. So that's something that we're in consistent dialogue with a lot of private equity sponsors. And really what the goal of that is to kick the can down the road. So long-winded way of saying, we're starting to see defaults come up. Higher rates for longer will continue to pressure that. But ultimately in a non-recessionary environment, it's not going to be too material impact from a market perspective.
So how is that affecting this sort of approach of your managers? You're talking there, I think you've described it as having your sleeves rolled up, if you like, and they're going to have to be doing that for longer and finding those different levers from what you've talked about.
Yeah, I mean, ultimately what we try to do and what managers hopefully try to do is focus on the underlying company fundamentals. So there's a lot of what we define as zombie companies right now where they're not growing and their balance sheets don't work and they can never grow into their balance sheets. So what we've tried to do in this space is find good companies that have bad balance sheets. That's typically the easiest way to do distressed investing, and then you can help to fix the balance sheet. So what we've tried to do is focus less on the companies that can never grow into their balance sheet or just having growth issues. So we try to find the ones where we define it what we call a win-win situation, where the company's growing, they just have had historically too much debt on the company, and that you're on the same team with either the sponsor or the equity owners, that you're fixing it for what could be a long-term good possible exit of the business.
And do those good companies particularly seem to be in a certain sector for you at the moment?
The sectors we tend to focus on, I mentioned just previously that there's a lot of volatility related to some of the policy issues in the US. So whether it's in the healthcare space, that's an area that we've been very focused on. Another area that you've seen some tariff issues has been in the building product space. That's an area where we're still undersupplied from a housing perspective across the world, particularly in the US. So even with tariff issues, that's one place that we've been finding a lot of opportunities specifically. So we try to go to where the opportunity set is, but those are two areas that I'd say people have been worried about the underlying fundamentals, where we've been a little bit less worried that the balance sheet issues we think can be fixable in those areas. You
touched there about that being around the world, and you are a global investor.
Yeah.
So what are you seeing in terms of opportunities in geographies, and how globally are you looking at the moment?
So you called me an optimist before, which I appreciate. Definitely, honestly, Europe, and it's interesting, we're here at SuperReturns, we've been finding a lot of great things to do in Europe, particularly the last 6 months. And post the election in November, there was a lot of, I'd say, optimism about the US and US exceptionalism, and it seems like that's sort of gone the other way. And when you look at who could potentially be the beneficiary of some of the US policies, one, energy prices being lower, and Europe is, a pure importer of energy, so that's very positive. Two, a push for deregulation. I think in some of the tariff talks, one of the things the U.S. has been asking for is, particularly on the tech side, to deregulate. And then, third, and I think most importantly, sitting here in Germany, there's been talk about spending more money for infrastructure and defense than even what was spent during the time of COVID as well. So two, which is a game changer from a European perspective. So we've been focused, I'd say the last 3 to 6 months, particularly in Europe, I'd say on intra-European businesses, so where you're not relying on US or Asia for growth in that sense. So some things on the travel side, some things on the consumer side in Europe, particularly in private credit. And that's been a really ripe opportunity set, as I'd say the competition in Europe has been a little bit less so than what's been in the US. And then the other area, from a relative growth perspective, is on the EM side. So as I mentioned before, consensus growth estimates have come down for the US and the dollar has weakened. So that's been actually a relatively good environment from EM as well also too, and thinking about, from that tariff world of who could potentially be the big winners. So I'd say Europe specifically, and then some areas in EM have been pretty good opportunities too.
It's always good to get a finger on the pulse of what's going on at GoldenTree with you each year here. So if we were to talk, on this sofa again in 2026, what do you think we'll be talking about then? Yeah,
I describe kind of growth at GoldenTree, and we just had our 25th anniversary, which is very exciting. It was a great milestone for the business and for our managing partner, Steve Tannenbaum. And when we think about it, we're always thinking about, where are we growing and how are we getting better? Because if we're not growing, getting better, then we feel like our competitors are. I mentioned it a little bit last year. We've really focused a lot on the real estate side. So that's an area that banks continue to pull back on, and we're finding some really great opportunities, whether it's been in the U.S. or in the UK specifically, have been on the real estate side. And then one other area that we've been very focused on has been, right now there's a lack of opportunities for sponsors or other owners of businesses to exit companies, because either the M&A market is shut down or even the IPO market while volatility shut down. So we're looking at providing a lot of other solutions, whether it's on the structured equity side, for sponsors, or even on the dividend side as well. So those are areas within the firm that we've been looking to grow the team, and I'd say we're most excited about here, and probably have a lot of good opportunities to talk about next year when we're here. So.
Lovely. I described you as an optimist last year, and I think that still stands. So thank you so much for joining me.
Thanks for having me again. Thank you.